pleasure when you have Nilesh Shah of Kotak AMC on the show. So let me welcome him. Nilesh bhai, good morning. Thank you for joining us.
Very good morning, Nikunj bhai.
It's quite unusual, right? On bad global days, we fall less. On good global days, we gain more. Indian markets, in a sense, have been extremely resilient in the global context. Do you think this outperformance is the real deal?
If we take longer term view, undoubtedly, yes. Over last decade, we have moved from 10th largest economy to 5th largest economy. Over the last 5 years, our corporate profit has moved from about 4 lakh crore to 16 lakh crore. Now, when your economy is fastest growing major economy, when your corporates are making profit and they are making return on equity, which is 1.5 times more than next peers, undoubtedly your markets will do better compared to other markets.
Everybody is now talking about bubble and trouble in SME. Every second conversation is centered around Indian valuations are stretched. Senior market veterans and folks who talk to us, including you've been calling out this market right now is running on steroids. Do you think it's time to exercise caution? Do you think it's time to be watchful? Do you think there are excesses in the market and they could trouble us and they could haunt us? And if there are, where are those excesses?
So again, Nikunj bhai, just anecdotal evidence. In last 10 years, SME index is the best performing equity index in the entire world. 66% compounded return. Now, if I go and meet SME entrepreneurs, SME bankers, they don't say last 10 years were the best in their life. In fact, they are complaining that business is becoming difficult. So what we hear on the ground and what we see in the market is very different. And hence, the usual caution comes into play. This is the market where quality should be preferred over momentum. Now, there will be questions, what is quality, what is momentum? Please exercise your judgment. This is the market where you prefer high floating stock, more market discovered prices than low floating stock, controlled ownership counters. And this is the market where reasonable valuations available in sectors like IT, FMCG, pharma, chemical, banking, maybe will do better over expensive valuation sectors like capital goods and SME and so on and so forth.
Attention to PSUs. Large part of the rally in PSUs was they were underperforming or they were underperformers of the last decade. Money comes back, it chases a underperforming sector, and then the government push towards defense, railways and capital expenditure really pushes these stocks higher. But of late, some of the PSU stocks have started reversing or at least have hit a pause mode. Do you think the big giant rally in PSUs, whether it's railways, defense or shipyard, is that over?
So again, within PSUs, there are variety of sectors. There are sectors in defense, railway, some of the low floating stock counters across sectors where we think valuations are high, not only because business fundamentals are good, but also floating stock is limited. And that has resulted into excessive money, resulting into excessive valuations. There are certain PSUs, including in banks, where there is market discovery of price because of high floating stock. And hence, those PSUs may continue to do well.
Markets are going up because there is a lot of liquidity. And if I add up all the liquidity which is coming not only from domestic institutional investors, which is let's say coming from insurance, LIC, pension funds, the number runs anywhere between 40 to 50,000 crore. With this kind of a liquidity support, can one be reasonably rest assured that this market will continue to climb the wall of worry, irrespective of the underlying valuations? Because if there is so much of fresh flow which is coming into market, buyers are more and sellers are less.
Nikunj, by time and again, experience has taught us that money can move the market for a while, but eventually stocks are slaves of earning power. Do remember that almost $1 trillion worth of stocks are with foreigners. If we continue to push prices to unreasonable level, undoubtedly they will come to sell. There are promoters sitting on probably, including government and foreign companies, $2.5–3 trillion worth of stocks. They can come to sell part of it if they believe prices are too juicy. So market mechanism will work. Money alone cannot drive the market. Today, our markets are running, in most cases, bearing few excessive valuations based on combination of liquidity, undoubtedly, but also coming on the back of positive fundamentals and positive sentiments. Today, as I mentioned, our earnings growth between 2010 to 2020, it moved from 3 lakh crore to 4 lakh crore, just about 25%. If we look at from 2020 to 2024, 4 lakh crore profit became 16 lakh crore. Corporates have tightened their belt. And that growth in earnings of almost 4 times is reflected into market cap. So as long as there is earnings, sentiments, and liquidity coming together, markets can climb any wall of worry. But if only money is driving and not the fundamentals, one day prices will correct.
Nilesh, morning. What's the outlook when it comes to the entire FMCG basket? Because all said and done, that's a space that has managed to do quite well. And what do the rest of the months hold in store, given that historically the second half of the year is fairly promising for the entire FMCG basket? If you were to stack it up when it comes to valuations, fundamentals, rural recovery and all of that, what's the outlook on FMCG?
So I wish this question had come to me 10–15 days back and I would have very comfortably said that yes, FMCG looks good. There is election money spending, there is budget spending, and there is good monsoon. And stocks haven't done well for some time. Valuations are elevated compared to market, but around historical averages compared to their long-term trend. And hence FMCG is one place which will outperform the market. The market is moving so fast that in just about a month or so, FMCG companies have rallied. We still believe within FMCG, on a bottom-up stock picking, there could be opportunity. For example, there are companies which are leveraging Pradhan Mantri Gram Sadak Yojana road construction to connect to smaller villages. There are some companies which are not leveraging it and hence their distribution or sales is getting impacted. But companies which are leveraging connectivity are able to grow much faster. Then there is element of cost. At one point of time, brand was important. Branding was able to push or pull customers. Now, people have become value conscious. I heard someone mentioning that this is the largest value migration they are seeing in their product portfolio. So overall, FMCG now on a bottom-up basis, companies which are value for money product, companies which are leveraging connectivity to expand their distribution network.
Okay, point taken. So that's a view on FMCG, but we are not asking you that 15 days ago, but we are asking you right now about the banking index as well. Do you think 15 days from here on, we'll be looking at a big recovery in some of the banking majors as well, especially the large cap private banks?
So in the banking, valuations are reasonable, but there is uncertainty hanging over banking sector. One will be liquidity coverage ratio guideline. If RBI brings liquidity coverage ratio guideline in line with the consultation paper issued, then certainly there will be impact on banks' profitability, and that's not reflected into market prices at this point of time fully. The second thing is also the liquidity or the deposit competition going on among the banks. Clearly, we do believe interest rates will start coming down over a period of time. But will banks be able to cut deposit rate as fast as the interest rates comes down? So that's another challenge. Between these two, I think it's time to watch banking sector and then invest based on when clarity emerges on these two aspects.
Nilesh, I'd like to draw everyone's attention to perhaps the way how the government positioning is changing. You mentioned elections, but if one looks at the central bank numbers, the capex this year is rather low. And if the capex is low, markets will start assuming that is government going easy on capital expenditure. And if government is going easy on capital expenditure, could some of those capital goods and private sector dominated names, could they hit a roadblock? It is very important for market to understand, or for viewers to understand, that what the intent of the government is. And looking at the political compulsions, could there be a divergence in terms of what the government action was versus what the intention now could be?
So again, Nikunj bhai, there are multiple aspects into it. Last year, we announced 10 lakh crore infrastructure spending. We achieved about 9,50,000 crore as election cycle came into play. This year, in the budget, we announced 11,11,111 crore. But please remember that April, May, and June were essentially under the election cycle, where government had limited ability to spend. Now they have to spend in about 9 months what they had budgeted over 12-month period. My feeling is that we will be little short like last year in terms of spending, despite government's push to do in 9 months what they intended to do over 12-month period. We had seen drop in orders from the government in the first quarter, that's June 24, but it should start picking up in September and December and later on. The second thing is on the state government side. Many state government has announced various schemes, and those schemes are funded essentially out of infrastructure investment. The collective spending by state governments on various schemes is about 1.8% of GDP. Now, that's going to have an impact onto the infrastructure spending. So I do believe state government's investment will slow down significantly as money gets diverted towards various other schemes. The third thing will be private sector. We believe private sector capex is on the revival mode. We have been saying that for last almost 18, 24 months, more of a hope trade than reality. But this time, there are signs of capex happening across various sectors. So between central government and private capex, infrastructure and other investments should go up. On the state government side, it should come down. And hence, we will have positive infrastructure investments over last year, but yet likely that it will fall higher expectations of the market. Today, many of the infrastructure capital goods companies are trading at very, very high valuation. Those expectations might get belied.
So you're looking at a revival perhaps in the private capex, and that's been a big question mark because we have seen the green shoots play out a couple of times, but they didn't really convert. Hopefully this time is going to be different. But Nilesh, what's the view on the power sector, given the fact that you talked about that the state investments and state capex is likely to come off? Do you think the investments which the states were making in transmission, etc., will also taper, and perhaps some of these power stocks are overvalued now?
So in power as a sector, we believe power demand is growing at a faster pace than power supply. There could be power shortages unless until we take some corrective action. And do remember that power capacity cannot come up in a short period of time. It requires a lot of planning, and hence it has a probably 5-year plus cycle. Now, within that, if we see, there are power producers, there are power transmitters, and then there are power equipment makers and fuel supplier. We believe, at least in gas-based power, the utilization is low. Gas prices have come down, and they will have ability to ramp up utilization to sell power at higher rates, and hence they should do well. The second is on the power equipment makers. We have a very positive view. As we see shortfall in power demand versus supply, more projects will come up and power equipment makers should benefit. The third will be power transmission. Undoubtedly, there will be a need to set up transmission lines and improve efficiency and reduce transmission and distribution losses. The investments could go up and down a little bit, but undoubtedly there will be investment towards better transmission and metering and so on and so forth. And finally, the big gorilla in the picture is the power producers. Over here, we believe those power producers who have more merchant power capacity, they should do better as power rates are likely to remain elevated. So overall, within power sector, valuations are high, most of the positives I talked about is already discounted into prices, and hence one will have to be careful on a bottom-up basis.
Be careful and do a bottoms-up analysis. That's the latest coming in from Nilesh Shah of Kotak AMC. Thanks so much for making time and speaking with us. Always a pleasure.
If you like this video, then like, share and subscribe to ET Now.